Today's guests are Jamie Grubb and Tony Talamas from Lument, and they are going to talk to us about multifamily financing. So they particularly focus on a lot of, I would say, small balance loans is kind of their core, as well as some bridge. So we put together a number of questions, but given the audience, we can make this very interactive. So we look forward to everybody asking questions and making it as helpful as possible. So, did you all want to? Why don't you can give an intro as well, Tony?
Sure. My name is Tony Talamas. I'm a direct lender with direct multifamily lender with Lument. We were legacy Hunt Real Estate Capital. For those of you who might remember Hunt Real Estate Capital, and we combined with Oryx USA bought us sometime in 2020. Combined 4 different platforms into one. We're now rebranded and known as Lument. I've been doing multifamily lending for almost 20 years now, working with a lot of very seasoned owner-operators and a lot of aspiring multifamily owner-operators as well over the years. Started out in New York, moved back home here to Houston in 2007, and have been working in the field since 2007 here in Houston. We do quite a bit. Small balance multifamily lending is certainly something that we're very good at. We also do a lot of conventional business and a lot of bridge business. We also have a lot of other products for different product types. Lument, you can just check out the website and see what that is. But for the most part, we specialize in multifamily conventional market rate housing. So, what else can I tell you? That's it. That's good.
Hey everyone, Jamie Grubb. See a lot of familiar faces. I usually attend these meetups, these lunches, so good to see y'all. I'm with Lument as well. I work with Tony here in Houston. As he mentioned, we're direct lenders, so we're not brokering out the deal. It's actually going through us. We have the licenses with Fannie and Freddie, so that we're going directly to the agencies on those deals. And then we also have on-balance sheet bridge products. So we're issuing those loans. We're not going out and shopping them to 100 lenders. We're actually issuing the term sheets ourselves and holding those loans. But as far as my background, I actually started out as an investor in multifamily before joining Lument. So I kind of have the investor side of things and kind of see it from that standpoint, but also on the lending side, looking at the loan to values and seeing it differently from that standpoint, looking at the credit, looking at the sponsor, and digging in deep onto the property and things that need to be watched out for. But glad to be here. Thank you.
Cool. Just a couple of administrative things. On the tables, you'll see little QR codes. Would appreciate if you'd sign in via the form. Then you can activate the QR code just so we know who's here and we can continue our communications on future meetups. Also on the back side, Ryan and I have our contact info also via QR code. Please do get those and reach out to us. We would love to connect with all of you that we have already not connected previously. So with that, thank you so much for coming. We already got the intro from you guys. Why don't you tell us a little bit about what drew you into the space, clearly with your background, you have done a variety of things. What really attracted you to the multifamily space, and what do you like about it on an ongoing basis?
Let's use that one. Yeah, that's what I like.
For me, I was actually a Wall Street trader up in New York, and I wanted to come back home to Texas, and we had an opportunity to work with Washington Mutual, who some of you might remember, and had an opportunity to transfer back with them into the multifamily space. And it just more chance than anything else, really, opportunity. But I've been focused on that space ever since early 2003, something like that. So almost 20 years. But what do I like about the space? It's always active. It's always busy. It's a preferred property type. There's certainly a lot of other property types to consider. They all present their own challenges, but multifamily has just always been something that's performed really well. If you have a good owner-operator, a good market, you maintain your property, it's just a good asset to have in the whole.
Yeah, and for me, I mentioned I was investing, in multifamily as a passive investor. But before, I was on the banking side, working in oil and gas. So in those transactions, we dealt with larger corporations. It was a small subset of the oil and gas market. And it was advising clients on acquisitions, looking at debt and bridge facilities that they can use to acquire clients, acquire properties. It was a lot more, we were kind of We're one piece of the entire value chain, I guess, within oil and gas. But then as I started investing in, when you're looking at oil and gas, when you're looking at real estate or multifamily real estate, you have a tangible asset. And I mean, that's something that was really appealing. You get to tour the properties, you get to see them, you get to see the tenants that are involved, you get to see like how upgrading units or changing things on the outside really affect the whole community around it. So I think that was one thing that was appealing rather than dealing with a lot of numbers and subsurface and geologists, geophysicists. I'm sure we got a lot of oil and gas folks in here, but it was really the tangible nature of real estate. And actually, going out and meeting a bunch of people who have started out by buying apartments, growing their portfolios, and having that more of an entrepreneurial spirit behind multifamily.
So maybe you can talk about what differentiates your product offerings or Lument from some of the other financiers in the space.
I can touch on that. So there's certainly a lot of players in the space. There's a lot of banks and credit unions, CMBS lenders, which you don't see much of these days. Life insurance companies, there's the agency lenders, and there's brokers who facilitate some of those transactions between borrowers and the lenders. Everybody has their own specialty. With respect to agency lending, there's probably 24 shops that have Fannie Freddie licenses, and the way that Fannie Freddie licenses work is that it's not a one size fits all. It's not one license that encompasses everything. You either get a small balance license, conventional license, an affordable license, manufactured housing license, senior housing license. So you get all sorts of different licenses. And we're one of the few shops that has most, if not all of those licenses. And we also have other products. We continue to look for new products to introduce to the market. So I would say two things. One is we are the direct lender. We have a very broad product suite to offer our clients. We also have a very robust technology platform to help clients through that entire experience from start to finish and after close. We service all of our loans in-house, which is a great thing. Aside from maybe the company level, there's also the personal touch, the relationship, the originator that you're dealing with. Everybody's a little bit different. You can have a mediocre originator at a great shop, and you can have a great producer at a mediocre shop. And at the end of the day, you really need a producer, originator, loan officer that you're working with to be in a great shop, to be able to facilitate your transaction and shepherd you through the entire process from start to finish and post-close. So I think one of the things that sets us apart, several of the things are the product suite. We have all those licenses. Two is the people. We have a great, you've been working with us now for a little while. I mean, we've got a great group of people with great culture. Everybody's working together to take care of the customer. That's not always true with some other platforms, right? Some of you may have experienced that in the past. But we do everything to guide our clients and advise our clients on the best course of execution. And we don't just try to sell a product. We try to advise based on what your objectives are, based on what your exit might be, and what you're trying to accomplish. Hopefully that answers it.
Yeah, that's great.
One question, just Tony mentioned that the servicing aspect is really important. Maybe just touch on that.
Yeah, so the servicing aspect, especially if we're holding escrows for ongoing replacement reserves or any immediate repairs, or anything for that matter, post-close, you're always going to be dealing with somebody on the asset management side. And some shops have reputations for having poor servicing departments, and others have better reputations. Back in, I want to say 2020, we actually spent a lot of money to build out an asset management team and bring it all in-house. And we hired something like 60 plus, maybe that number's more now, people on the asset management side to work with our clients directly. So they're direct employees. We all work together as a team to take care of our customers, and we're actually spending a lot of money on a technology platform to help in that servicing aspect of the business so that it makes reporting and asking for draws and requests a lot easier, a lot more efficient, a lot smoother.
I'll do one more question, then we'll go this way quickly. So maybe you could just paint for us a picture of how you see financing for multifamily. And let's talk about Houston, how that's changed, and what it was like, let's say, 3 years ago, what it's like today, or maybe just draw some color on what LTV, what rates are, what the products people are using, just kind of walk us through what that was like today.
Man, it's changed a lot over 3 years. It's changed a lot over 3 years. It seems like, you know, three years ago I was sizing a lot of deals, and it was pretty rare to not be able to hit that 80% metric. It was just, you know, anytime I didn't hit 80%, I had to ask, what's wrong with the property, or what am I missing? And now it seems like it's kind of flipped. Like, so if I had, for every 10 deals I saw, if 2 of them just didn't size well, it's kind of flipped. Now I look at 10 deals, and 2 of them, maybe I get to 75% plus. And I get excited. I tell my client, you got to put this through a contract. Hopefully it works for me. It should work for you, right? I mean, a lot of it has to do with cap rate compression and valuations. There's just a lot of cash out there. There's a lot of buyers out there bidding up properties, and valuations going through the roof. So, you know, the fundamentals really haven't changed all that much, except for the cap rate compression. So, you know, conceptually, we can still get to 80% LTV as long as we're constrained to a 125 debt coverage ratio. In other markets like Dallas, you can get to 120 minimum debt coverage ratio, but we're always going to be limited to either the lesser of 80% or a 125 debt coverage ratio in Houston. So right now, the problem is not getting 80%. It's the fact that we're debt coverage constrained at 125, and we're not, you know, depending on the deal. 2020, 2021, early 2021, we're probably sizing a lot of deals at the 55 to 65% range just because they were debt coverage constrained. Now I'm starting to see a little bit more deals in the 65 to 75% range, which are starting to work. But other than that, the biggest thing I've seen, I mean, obviously COVID has changed the guidelines and the rules and how we lend and how we look at things. Fannie and Freddie credit, and probably a lot of other banks and a lot of other lenders are looking at things a little bit differently. They're scrutinizing deals a lot more closely, looking at the history a lot more closely. They're not just looking at T3, they're looking at T12, they're looking at the history, they're looking at the sponsorship experience, they're looking at the submarket, they're looking at everything more closely than they ever have to make sure that the deal makes sense and make sure there's not a lot of risk in using.
Yeah, and I'll just add on that, in Houston in particular, I mean, the insurance costs, and if you underwrite deals, you can see that the insurance costs have been coming up. And when Tony's talking about the sizing not working, it is because of the cash flow of the overall property. And driving that is the expense growth, and mainly insurance and taxes. So those numbers coming up also cause lower sizings or lower proceeds on the actual loan side.
You know, on the subject of balance sheet and how much you guys lend, can you talk us a little bit through how you determine how much of your balance sheet you're going to use for lending? What's your size of the loan portfolio going to look like? What drives rates? And you know, we frequently hear, certainly from our mortgage broker, towards the end of the year, hey, look, this you know, X, Y, and Z firm out there has got loan capacity, so they're willing to do a more aggressive loan. And sometimes we hear, hey, they're hitting their capacity and they're not able to lend to us. So can you give us some color as to how those dynamics work, how you determine the size of the balance sheet you're going to use, what kind of rates you offer, how do you turn on or off the faucet? Is it through the rate mechanism, or do you just tell people we don't lend? Just if you could give some color on these.
Yeah, so on the agency side, they actually set the metrics, so they set the amount of loans that they put out at the beginning of the year, before the beginning of the year. So last year was $70 billion between Fannie and Freddie. Then this year that's $78 billion. So they're working with that number for the entire year. And they, you know, they'll start off and they'll look at it on a monthly basis or a quarterly basis to see, okay, how much volume do we have? Did that go up?
Perfect. So I'll address the bridge side first, because I think your question was related to bridge. On the bridge side, I think every bridge lender is a little bit different. Just depends on how big their balance sheet is, right, and how quickly they can raise funds. I would say, you know, we're backed by a very big parent company, so we've got a rather large balance sheet. I haven't seen any constraints there as far as not having an appetite to make more loans. It's just more a matter of do we want to make that loan? Is it a good loan? Can we see an exit? You know, I have seen instances where they like a particular property type, they like a particular market, and they like the transaction, that type of transaction overall, but sometimes they might put the brakes and say, well, we're not going to lend anymore in that market because we've just done 5 deals in that particular area, and it becomes a concentration issue. You don't see that as much on the agency side. Fannie, Freddie, they've got a lot of money to deploy and a lot of money to lend on multifamily properties. You're going to get better pricing on what they consider mission-rich affordable housing. So if you're buying a property or own a property that has rents that are relatively affordable relative to the rest of the market, then you're probably going to get some better pricing concessions than you would on the Class A property. Right? But for the most part, the demand is strong. There's always money to lend in the agency world, and as far as you're probably going to get some better deals and more appetite at the beginning of the year, because as you approach the year end, especially if you've already hit budget, you're going to see the rates artificially rise to be able to regulate some of that demand, right, or being able to pick and choose. But typically in the beginning of the year, first half of the year is where you can see, where I've seen historically just more competitive pricing and such. So.
And then, you talked about you're finding it hard to see agency deals sized for 75% for full leverage. So, with the caps increasing this year, what happens if, are the agencies going to get that much more aggressive and lower DSCRs, or what do they do if most of the deals, at least in the B and C space that I see, everything seems to be bridged, so how do the agencies compete against that?
I don't see them lowering debt coverage ratio. I think if somebody wants permanent financing, they're going to be expected to bring more cash to the table to bridge the gap there. But that's a short answer. Just, you're going to bring more equity. Yeah, exactly. So I don't think they're going to be. I think when it comes to debt coverage ratio, that's one of those credit parameters where even if you're hungry for business, they did well. They did well, and they're going to continue to do well. And I think most of their portfolio is pretty low leverage to begin with anyway. So I don't see them getting aggressive on any kind of debt coverage ratio, reducing debt coverage ratio just to do more deals. I don't think they need to do that. I don't see them doing that.
All right, I guess I'll take another one. So given that clearly you guys evaluate markets and see what markets you'd like to lend into, would you be in a position to give us some color on markets that maybe personally you like or maybe the firm likes, and give some color as to why?
I'll go quick. Yeah, I think it comes down to, on the agency side, you're looking at the debt service coverage ratio. So as Tony mentioned, in certain markets, top markets, you can be 80% and 120 debt service coverage ratios. And then as you get into very small markets, and this is all dependent upon renter population of the area or the MSA, it's a 140 debt service coverage ratio and a 65% loan to value. So you work your way down in tertiary markets or smaller markets on your metrics. So you can't really go above and beyond on those from a sizing or from a loan to value standpoint.
I wouldn't say there's any preferred market when it comes to Fannie and Freddie being able to lend on a property. I think what they really, obviously they're going to be more desirable some markets, and that's probably going to drive some of the LTV and debt coverage ratio requirements, obviously. But as long as it meets the mission of providing, maintaining and preserving affordable housing, workforce housing, that's going to be a mandate to finance those properties and keep those properties going. So I think one of the probably better questions is, is it a neighborhood that's got an issue with crime? Because sometimes that's where we see credit might pass on the deal. If there's a lot of crime at a property and there's no mitigation plan for that, then yeah, I can see somebody passing up and somebody credit passing on that deal with good reason. But for the most part, I wouldn't say there's any, for the purpose of actually making a loan, there's no better market or worse market, although there are better and worse markets from our perspective. We'll lend anywhere in tertiary markets, small markets. I've lent in Lufkin, Nacogdoches, Beaumont, and of course Houston, Dallas, larger markets like that. With respect to Bridge, they're going to be a lot more selective. They've got less money to lend, so they can afford to be a lot more selective. They're going to look at bigger markets like Houston and Dallas, and they're going to look for a clear exit. They're going to look for strong ownership experience, operator experience, and such. So they're going to be digging into the numbers a lot more and being a lot more selective.
Tony, you mentioned crime. So what crime stats do you look at? What services do you use to quick screen, hey, this is an area that's going to be challenging for us to improve?
We have Lexis and Nexus, and then there's something I think called Community Crime Map. I've got a bookmark, so I forget the link. But a lot of the stuff is online now, just to be able to see what kind of crime it is in an area or the property. And sometimes we might have crime surrounding the property, not at the property, which is fine, as long as we just address it. Hey, we've got security, we've got lighting, we do tenant screening, we've got gates. If you can address that, and there's no issues at the property, then you're fine. But if you have a history of crime, comes up time to time. If you have a history of crime at the property, nobody's ever done anything to mitigate it, well, it's going to be harder to say yes and harder to do a deal. But I rarely see those, probably seen one a year or something like that. Yeah, anytime I see it's usually just a one-off thing, and not something that's just going on every day or every week, but every once in a while you get something with a lot of crime, and those you just know to pass on pretty quick.
And I'd also mention just a Google search of the property. I mean, if you Google search something, you see continual crime or people always showing up at the property, or different kind of crimes that's in the news. I mean, it could be because someone from the news station lives there and they're just targeting that, trying to get the buzz out on it. But those are the things that we're going to be searching, is actual news articles, and that's the things that everyone's going to be looking at as well.
Let's dig into a little bit on the actual deal process, underwriting, if you will. So, can you talk to us a little bit about how you evaluate deals from an underwriting perspective? How do you look at rent growth? How do you think about cap rates, particularly exit cap rates? And then, when it comes to the metric you evaluate, Ryan and I are talking to investors. We need investor metrics. Lenders only really care about DSCR, and then after that, they don't really care how the deal performs. Just some color on that would be useful.
Yeah, we're gonna look at things a lot differently than owner operators and look at things, right? We have to take those metrics with respect to LTV, debt coverage ratio. With respect to income, the way we're sizing deals on the Fannie and Freddie side, we're looking at in-place income, and we're looking at that trend in income, right? We cannot underwrite the pro forma income. We have to underwrite the in-place actual income. And we're going to look at the trend to determine, well, do we underwrite to T1, T3, T6, T12? So we're looking at that trend. It's very important for us to collect a very detailed T12 that shows collections month to month to month, and preferably accrual. Sometimes we get cash savings, and we should know upfront what that is, so we can be able to determine some of the smoothness or some of the chalkiness in some of those collections. But we look at in-place income. When it comes to expenses, as Jamie touched on earlier, taxes and insurance are a big one. When it comes to comps, we've got access to every Fannie Freddie comp there is, being licensed lenders. When it comes to insurance, I really don't lean on that comp. I just look at the most recent deals and ballpark it from there, unless we have a live quote. But insurance is just one of those things that keeps going up and up. You get a comp, and the next quote you get is higher. Taxes, typically we're underwriting. It depends on the story, depends on the market. We've underwritten some deals as low as 50, 55, 60% of value or purchase price. It really depends on where our benchmark is, what the rest of the comps are, and what that appraisal district is doing. But generally speaking, I like to underwrite somewhere between 75 and 80% of value or purchase price, and that's where I'm comfortable. If we need to make an argument for lower, we can, but we should be prepared to absorb any increase in year 2 or 3. So that's an important question to have going forward. With respect to the other line items, utilities, we just generally underwrite to actual. There's nothing we can do there unless you have some major story to tell there. Payroll is another one. We underwrite to actual unless you're buying a property that has too many people on the payroll, and you have a clear plan to reduce that payroll, and it's supported by the comps, and we can underwrite to that lower number. And management fee typically in 3%. But one of the things we do more specifically is I like to sit down with my client. Once we spread the numbers, I compare the actual operating history for that property with the comps that I have available to me and with the buyer's pro forma, operating pro forma. That way we can compare all three and determine, okay, well, I see some trends here, some red flags here. We might need to discuss some of the possible obstacles that might pop up during underwriting, during due diligence, right? So we want to look at every single one of those line items and the trend more specifically. Every now and then somebody will send me just a summary. I think we got a deal just recently. We just sent a summary. You can't really tell much from a summary. I don't think you guys as buyers want to look at a statement and make a decision based on just on a summary. Shows this is what we collected in 2021, right? And you don't know if it's going up or down, and that's important because if we can't make a quote based on the summary, because if collections are going down and then I issue a loan application, you tie up the property and you put money hard, and then we determine during due diligence that collections are actually declining, well, you're going to get a haircut on the loan. So you don't want to be in that position. It's always a good idea to get T12. And 95% of the time we get a full T12. But I think that answered your question, hopefully.
Yeah, what about, sorry, just about,
Yeah.
talk about cap rates then.
Cap rates, yeah, that's a good one. I mean, it's, you know, they keep going lower and lower. We've seen a lot of deals with 3 caps, 4 caps. Generally, I'm seeing appraisals at 5 caps. I think it's a question of how you underwrite the deal. One metric I prefer to look at is price per door. I like to see price per door and see how that shakes out to a cap rate. And cap rate is certainly one of those questions we look at, and one of those benchmarks we look at compared to other deals getting done. But at the end of the day, if the deal underwrites and is supported by an appraisal, it's something we can do.
Yeah, I'll just add to that. Lenders normally don't look at cap rates, but the lender's cap rate is called a debt yield, so it's NOI over the debt, and so it just kind of shows you how many years NOI can pay back the debt, or what percentage of debt is the NOI. So we really focus on that metric, and you know we have different metrics for bridge. We'll look at deals that are between 4.5% to 5%, 5.5% going in, and then you know we look at an exit debt yield, and that's where it's increased by 200-300 basis points on the exit, so that we see, okay, the NOI has grown to a certain amount to where it's you know taking up a little bit more portion of the debt every year. So we don't really focus on cap rates necessarily.
One thing I will add, as a buyer and as a lender too, we're looking at an exit, and I think as a buyer, you probably need to look at that cap rate very closely and see how much rent growth there really is, because if you can't drive value at the end, you know, what's that exit look like for you and for the lender? One of the tests we do that nobody really knows about or hears about or is really talked about is the exit test. You know, once we determine, okay, you can get this loan amount based on that 80% LTV and 125 debt coverage ratio, we do in the background a stress test or an exit test to see if the deal exit in year 5, 7, 10, whatever your fixed rate term is, right? So if we don't pass that exit test, then we're going to reduce the loan until we do. And continue to do that. And that exit test takes into consideration a lot of different things. It takes into consideration going in collections, your rent growth, you're going in expenses, your expense growth, cap rate, terminal cap rate, start rate, terminal start rate, terminal rate. So it takes into consideration all those things over the life of the loan to make sure that you're not underwater when it comes to sell or refinance the property. And interest only plays in there after that, right? So the more interest only you have, the more years you have, the less time you have to pay down that principal, and the harder it is to exit, right? So all of that's a formula that happens in the background of the workbook that we have. And I think buyers just need to think very carefully about what they're going into the cap rate is and how much value there is to really add and drive rent growth to be able to, I mean, 3% cap rate, 4% cap rate, I don't know how you guys are looking at the exit. Are you maybe 2 only 2 cap?
Much higher.
I think Rob and I are probably a little bit conservative, but, you know, typically for B and C class, I mean, you know, the last deal that we bought in May, it was 5 3/4 exit cap. And, you know, now it's going to be south of that, just to make it deal pencil, but.
And 5 3/4 felt tight, right?
Yeah, that felt tight, but it was like, they were restricted it, but, you know, obviously, now it's probably closer to 5, probably to the 4s, which is insane. But Tony had touched upon, sometimes someone might send you, not a T12, but when you're saying a summary. What would you like to see in an email from someone to saying, hey, Tony, size or Jamie, size this deal for me? What do you want to see? What color, qualitative, quantitative would also be helpful? What's an ideal email to get from a potential client?
I would say that typically when I see those summaries, it's more on the small balance side, not so much on the conventional side. But typically when I see at a bare minimum, I need a property address, and I need a detailed rent roll showing the unit mix and how many units are occupied, how many are vacant, and I need a T12 showing income and expenses over the last 12 months. That's what I need at the bare minimum. What I need to issue a quote is if we're working for this the first time, or if you're working with any other lender or broker for the first time, you know, it's a good idea to share with them your experience, what your personal financial statement looks like. You know, are you syndicating the deal? How much cash are you putting into the deal? How much are you raising? Who are the other KPIs? What's your experience? Do you have a bio or resume to share? Do you own or invest in any other property? Share your schedule of real estate. So on the sponsor side, if you can share those pieces of information, that's great. On the property side, rent roll T12, we'd already have that. But then you can also add some color as to capital improvement, pro forma operating budget. I always love to see that to make sure we're comparing apples to apples and on the sizing. And I think that's it, really.
Yeah, and I think it's important if you're going for bridge, it is, if you have that experience level or bio that kind of gives an overview of what you've done in the past and what the, the business plan of the property is. It's more important for bridge for us to fully understand that story and the sponsor's experience.
On the question of sponsor experience, can you talk a little bit about, the concept of bad boy carve-outs, how we can mitigate that as buyers, what do you look for in the team buying the property and essentially lending from you, some color on that?
Yeah, I mean, I guess for me, for bad boy carve-outs, like anytime someone commits fraud, I think a contract is, null and void. It's a carve-out for fraud mainly, but I mean, there's other things that can go on, but it's not like, I don't know, I mean, it's not like a number was missed. It's intentional, and it's things that, that allow the bank to come back and get the debt back or be made whole. So although, non-recourse, everyone, I've heard it described as you don't have to pay it back because it's non-recourse, which isn't true. You have to pay back your loans no matter who it's to, but bad boy carve-outs just kind of prevent the fraud aspect.
So I interpreted your question a little bit differently. I'm thinking about it from your perspective as a buyer who you're partnering with, and same is true as in any business, in any industry that you operate. It's just knowing who you're doing business with, right? I've been doing this a long time, and I see a lot of people who, with experience, who easily sign their name on deals with other people just to kind of scale faster, and maybe they get some sort of promote on that. Maybe they know each other, maybe they don't. And I've talked to some people who absolutely, under no circumstances, will sign for somebody else unless they have some sort of control over the entity. And quite frankly, that if I were doing that, that's the route I would go, simply because, if you're partnering with somebody and you don't know what they're doing, they could reflect poorly on you if things go south or go sideways, right? So I interpret that question as do your homework, know who you're partnering with, know who your KPs are, know what experience they have. If they've ever had any issues with respect with any lenders in any respect. So I think it's very important to do your due diligence and knowing who you're working with. And I say that because I've seen a lot of people partner up with people who they just met and haven't really known, got taken the time to really know. And we had a deal just recently where the guy relied on one person he met at some event. And we were ready to go to committee, and we're just waiting to understand what the equity structure looked like and where the equity is coming from. It's coming, he's bringing the paperwork, I promise. Never showed up at the table, so yeah. The guy lost a lot of money. So I think it's very important. It rarely happens, but and most people already know this, but that's how I interpret that question, is just knowing who you're getting into business with.
Yeah, and also, how do you evaluate?
Like, what are the processes you go through to evaluate the team overall? Like credit checks, what are other things you kind of do to evaluate the GP team before you go over, I guess?
So from that perspective, yeah, we're going to look at the team's experience. There's 3 partners, 5 partners. We're going to look at everybody's personal financial wherewithal, net worth, your holdings. We're going to look at your experience, how many properties do you own and operate, how many have you owned and operated, when did you get started, what has your success been, right? And most lenders kind of know there's a track record, right? People have been around long enough. If you haven't performed well, lenders know, right? So it's important to do everything you can to make sure your properties perform as well as they could, and not scale until you have those under control, and scale when you can. But things we're looking at are just basically financial wherewithal and experience, and we do credit checks, background checks, pretty detailed background checks, make sure there's no lawsuits or any kind of fraud or anything like that. So any arrest records, some things can be explained away, others can't. But credit checks, background checks, and experience will be foremost.
Yeah, and just to add, I think the experience part of that, looking at the schedule of real estate owned and seeing what those metrics are on the debt. If you're a GP on a property and you're not meeting your debt service coverage ratios, or you're in some kind of trouble on a property, then that shows up. So just to make sure that the experience that you have, everything's in good working order, is is tied up before you go off for the next one.
So is there any way, just going back a little bit, is there any way for you to see quickly if a deal will size with full leverage? Is it just, hey, I'm looking at the cap rate, if the cap rate's here, you're probably gonna get full leverage?
So, I mean, I could quickly run the back of the napkin approach and just take your NOI that you're underwriting to, see if it makes sense relative to the other comps as far as my expense number is per door. So I don't like to do that, but if you're looking for quick analysis and quick guidance, I can do that. I prefer to set up a whole deal with a T12 and see the collection, see the trends, and see where I might be able to tweak numbers and support numbers, especially on an acquisition. So I like to do a little bit more of heavy lifting up front to see where you might be able to shake out, and maybe it's going to be less, maybe we can get more than what you're thinking. So I don't like the back of the napkin approach, but you can do it.
Yeah, you lose a lot in, I guess it's kind of like a quick look. You lose a lot in that quick look. That there's so much variability as to, is it actually going to size to this or not, that you kind of lose a little bit of the interpretation. So yeah, that just adds on the attorney's point.
Yeah, I would add, it doesn't take us long to size the deal and look at the trends. I mean, we send it up to our bullpen and our analysts, and they can have a workbook back to us within, depending on what time of day it is, within 24 hours, sometimes 48 hours. We can be giving you pretty detailed feedback within 48 hours, so it's worth the wait.
That's helpful. So in terms of if an owner wanted to self-manage, what do they need to do? Let's say they haven't self-managed before, and like, now's the time, I can do it better than the next guy. What would you say to them? What process do they need to go through? And does that depend on asset unit size?
It depends on the experience. If they don't have experience, you have to get a third-party manager. It's not an exception I've seen granted anytime recently. So I would suggest to people that the path of least resistance is to get a third-party manager, and after a year you can apply with the asset manager, whoever your servicer is, to self-manage. I would advise, I've had customers who didn't like that and came back to me a year later, they still have a manager, and they say, listen, it worked out well, I learned a lot working with that property manager, now I'm ready to go out on my own and do it on my own. But I would suggest that you hire a third-party manager, shadow them, watch them closely, work with them closely, learn what they do well and what they don't do well, and then apply to self-manage after a year. So if you can explain to that asset manager that you've been very involved in the property and explain what you have done over the last 12 months, it'll be an easier approval process. So and if that doesn't work, then try it in the second year. By year 2, you should be able to get self-management approval. But for starters, I would always suggest plan on identifying third-party management. It's an expense that you're probably going to have to just deal with, unfortunately, especially if you want to do a Fannie Freddie deal or a bridge deal.
Just riffing off of Ryan's question about that initial email from the buyer. Typical closings are usually 2 months, sometimes even longer. And a good part of that is, obviously lender due diligence, appraisal, all of that. What are things that buyers can do to help ensure certainty of that timeline? Are there things that you see where, hey, this buyer could be a lot tighter in the process getting stuff to us? Can you share some color there? What can we as buyers do to make sure you guys can operate as efficiently as possible?
Just a quick one is having all the information in order, having it together and well packaged. Piecemealing information, I guess it doesn't help us. I mean, we can put it together, but really if we're waiting on information to come through, I think that's kind of the main thing. And then
Yeah, I would say from the lender's perspective, it's rather a streamlined process. We do this every single day. We have a very clear-cut process. I mean, we close deals within 30, 35 days of being in that position. So the question really comes down to, especially on an acquisition, it's a lot more challenging, right? There's a lot of different parties involved in getting an acquisition done. You got your buyer, you got your seller, you got the buyer and seller reps, you got attorneys, third appraisal reports, which you're going to get refinance anyway. But there's a lot of different parties involved. If you're doing a syndication, that's another step in the process, right? So I think just anticipating every piece of information you're going to need early in the process and trying to get a handle on that as soon as possible and getting that over to the lender in a timely manner is key. I've had deals where the buyer is on top of things, but the seller checks out and doesn't provide information, or you might have a pretty decent seller, but a broker, a listing agent, or a sales broker who's not that experienced, just not that motivated, and slows down the process. So everybody has to be aligned on that mission and that time frame, and if there everybody is, things should go smoothly. So one of the things we do as soon as we sign up a deal is we have a kickoff call. On that kickoff call, you're going to meet your underwriting team, so you'll have direct access to an underwriter and an underwriting analyst. And we're going to talk very carefully about the process from that point forward to closing. We're going to talk about all the due diligence items you're going to need. There's going to be checklists that we populate online on our technology platform that you'll be able to see all the items that we're going to need. Then we're going to engage our lender counsel, will reach out to your counsel. They're going to send a welcome package saying this is exactly what we need. And the same thing is going to happen on the insurance front. So as long as everybody does what they're supposed to do, when they're supposed to do it, things should go smoothly. And as a buyer, I always tell the buyers to make sure to reach out to their counsel. Sometimes there's one, maybe there's a transaction attorney, a syndication attorney. Reach out to both, tell them, listen, I need you to get all these, and monitor, watch them. Make sure they're doing what they're supposed to do when they're supposed to be doing it. And the same is true with the insurance rep. I've seen some insurance reps that move very quickly and others that don't move as fast. So make sure that your insurance rep is providing all the information they need. And typically you're going to be copied on all those emails, so you'll know what's going on, or you'll get a phone call from me or Jamie saying, hey, listen, we need you to give so-and-so a push. But really, from our perspective, the process is in place. We know the drill. We do it day in, day out. So as long as people get to us the information that we need in the format that we need it, we can move quickly.
Ravi, how much time do we have? Sorry.
We got 15 minutes.
15 minutes, okay. So, I want to just touch upon refinancing. So let's say that someone bought a deal in the past 2 years. So they bought probably 2 bases relative to where things are trading today. And they're thinking, should I sell, should I refinance? I would love to hear your thoughts on how you would walk through that. What terms would be available for refinance that might be different than a new acquisition?
So generally speaking, and not in all circumstances, refinancings are a little bit more conservative than on an acquisition. It's a hard question to answer as to whether or not you want to sell or refinance. A lot of the deals I've seen recently where people are really trying to capture as much equity as possible. The real answer is you probably want to sell it to capture as much equity as you can, because if it's a value play and you bought it and you've repositioned it and there's a lot of equity, you've driven value, the chances of you getting all that equity out within 24 months is a little bit tougher, because you have to demonstrate. At the end of the day, we're going to be looking at cost basis, right? You bought the property for this amount, you put in this amount, that's your cost basis, right? And we're never going to go above, if you've owned the property for a long time, we can go above that cost basis, but within 12 to 24 months, it's going to be challenging to get credit comfortable with anything above, say, cost plus maybe 10%, maybe 20%, depends on what you did. But the typical value add play, you're going to be at 90 to 100% of cost basis within 12 months, and maybe 100 to 120 within 24 months. Beyond that, it gets a little bit easier. But most people who are trying to flip within 2 to 3 years, your best play is probably selling the property.
But if you're 100 to 120% of cost basis, that means you can return the equity.
Yes, you could. Yeah, no, absolutely. Yeah. And we get some buyers who just want to return the equity to investors, or just get a better rate and get a longer-term fixed rate loan, and that's fine. Other people want to maximize and pull as much cash as they possibly can, and in that case, you're going to want to sell the property.
Yeah, I'll add to that. From an investor standpoint, or from a GP standpoint, looking at the refinance, which is a non-cash event or a non-tax event, versus selling it out. You're paying taxes on that. So matching the equity here in the equity story, what the investors want to see. Are they looking to, can they pay taxes this year, and really taking a poll? I guess that's how I look at it from that standpoint. But yeah, it's like Tony said, it's not a simple, hey, we did this deal, we executed on our plan. Now cap rates are 3% instead of the 5% that I bought it on. Now I want to refi at that market value. It's not that easy. So it's there's more to it, and credit's going to be conservative, especially with something that's been bought within the past year, 18 months.
I will add to that, you reminded me, cap rate compression, you're not going to get any credit for cap rate compression. If you're looking for a cash out refinance, you have to demonstrate that you added value to the property. You put $5,000 per unit into upgrading this, that, and the other, and you increase rents by $100 across the board. If you can demonstrate that, then you'll get a cash out. But if you haven't done much, and I've seen some of these deals where people want to do cash out because the brokers are telling them, oh, your value is now worth this. If you haven't really improved collections or operations, more importantly collections, you're not going to get much of a cash out based on cap rate compression at all.
Should we open up to the audience?
Yeah, I think so.
Any questions? All right, good, awesome. I don't know, Greg, if you were, was that hand up or?
No, not yet. I'll ask.
Head fake.
Thanks for a lot of great information here. So we are negotiating through a loan, and our broker has placed it into Lument, and it's a bridge loan. And we've done agency loans before, but this is like so many variables, and they seem to be negotiable. So I just asked, by the way, can you remove, for example, the soft lock box, or can you reduce the requirement for network? And they did it right away. But there are so many variables, and we don't really know how to negotiate through all of this. Can you give some pointers what all can be negotiated down?
You know, I don't think there's a black and white answer for that. I don't think there's a black and white answer for that simply because every deal is going to be a little bit different. It really depends on what the economics of the deal are. You know, are you asking for 70% or 80%? Is it a strong submarket where you know where the metrics or the fundamentals are much more favorable than another deal? What does the sponsorship look like? Do they have a ton of cash? Do they have a ton of experience? So I think whether and also what's our concentration or our appetite, right? If we're really hungry for business, then yeah, a lender's probably going to negotiate a little bit more. But if you're not hungry for business, they're going to be less likely to negotiate. So it's hard to say what those points might be that would be negotiable.
Yeah, with all lending or all debt, I guess there's a give and take. I mean, if you do have something that isn't important to you that you can give on some of the negotiations, then you can work it from that angle. But I think that, yeah, it's all dependent on, I guess, the deal, property-specific, sponsor experience, and other parts. It would strengthen the deal, because that's how credit looks at it. What is being strengthened? If we just keep giving everything away, does that weaken the overall deal and our position as the lender? So they'll look at other things that you can give on top of it.
We also noticed a large breakup fee. Is that pretty normal for a debt fund like this?
A large breakup fee was the question.
You know, I'm not sure what other bridge lenders are doing with respect to that, but typically there's some costs associated with committing some of the resources to that deal, right? So there will be a breakup fee involved in that. I don't know what other bridge lenders are doing though.
That's if the contract gets terminated before closing.
Right.
Is that-
Yes.
Yeah.
I got a question.
So you may have already indirectly answered this by talking about debt service coverage ratio in Dallas versus Houston, for example. But Houston is a pre-review market, right? So as a buyer, what types of things do we need to keep in mind when underwriting, considering that fact for agency debt?
So I think it depends on what loan size you're in. If I think it really depends on the loan size. If you're looking at a deal between $1 million and $6 million, you can go Freddie Mac SPL, which is going to be 80%, 125 debt coverage ratio. If you're looking at a larger deal, $6 million plus, we're probably going to be constrained to 75%. On bridge, we might be able to push 80%, but if you're looking for agency, we're going to be constrained to 75% on deals north of $6 million in Houston. Now, for people who don't understand the pre-review process, a lot of times you don't get to see it because it's just something that happens behind the scenes. But generally speaking, what it means is Fannie Mae has placed Houston on pre-review, meaning that any deal, there's no lender that has a Fannie license that can lend more than 65% LTV without going to Fannie Mae for a waiver. Now, a lot of people don't see that in the background. We just go in and get the waiver. There was a period of time where they weren't giving the waivers, but that was a long time ago. Now you can count on 75% LTV. So LTV is one of those waivers. Another waiver that nobody really knows about is interest only. Every lender is delegated to only lend to do 12 months of interest only period. Anything beyond that is a waiver. It's an easy one. It's never really talked about. But I say that because a lot of times people ask, well, why did this guy next to me get 5 years of IO, but I'm only getting 2? And a lot of times it has to do with those exit tests I talked about earlier.
Any other questions? All right. I think you had your hand up first from before, so I was trying to be fair here.
So you had mentioned that the cap rate is not something you guys look at, price per door. Is something, do you have an average price per door based on the different classes, A, B, and C, that you could throw out to us, take an idea?
I don't. You're welcome to reach out to us because I think every market's going to be a little bit different based on where it is in the market or maybe the age or the size. So I think everything's a little bit different. So I think it'll be unfair for me to give you a number that might or might not work, right? So I think the best thing to do is to reach out to one of us and we can tell you, well, this is what we're seeing in that particular submarket.
But is that driven a little bit by replacement cost, or how are you?
No, market value. We're looking strictly at market value, either recent appraisals or what we have in our comp set, or just reaching out to one of our appraiser contacts to make sure something's in line. I mean, it's a lot of it's just kind of seeing deal after deal after deal and understanding what's getting done. And a lot of it's not just my deal flow, it's the whole group's deal flow, and even Fannie and Freddie's deal flow, and looking at what the comp set looks like, and then kind of confirming that with an appraiser. But we can typically give you a ballpark. I'm reluctant to say what that number is now because every submarket is going to be a little bit different.
So, Tony, on the issue of refinance, you said you don't consider the cap rate, but the question comes is, like say, 3 years after somebody wants to refinance. In 3 years, rates have gone up, and your NOI has gone up, rents have gone up, and the person has invested. So in that case, your property value has gone up, but you don't consider the cap rate, so how do you take the property value, how would you calculate the property value at the time? And then the question comes to it, what you calculate and up to what value then you refinance on that.
So it's a function of seasoning, right? If you're looking for cash out refinance within 24 months, it's going to be, and you mentioned it's going to be value creation. What did you do as an owner operator to drive value of the property? If you increase rents and increase collections, improved NOI, then you're eligible for cash out. But if you did nothing, or maybe you tried and you weren't successful in doing that, I've seen those transactions, just relying on cap rate compression, the market lifted value, that's not going to happen. But if you can demonstrate, hey, I came in here, I turned this thing around, I re-tenanted the place, I improved the property, I drove rents higher, then we can say, oh yeah, you've added value, we can get you a cash out. So, and I think you had
Yeah, so how would you calculate the value at the time?
Oh, it's going to be based on the appraisal report, but we're going to be constrained somewhat to cost basis depending how long you've owned it, right? If you're past that 4-year mark, it's a lot easier. If you're trying to get a cash out in month 15, it's a different story. We're looking at cost basis.
Yeah, and along that same line is to keep good records as to what you're putting into the property. So just making sure that the cost basis is fully baked in, that it's not only certain things. And, yeah, just making sure that the good records are kept. And how much of that is one time versus, sometimes things are thrown in R&M, which shouldn't be.
I'm glad you said that because I always tell people that, and I forgot to mention this, I'm glad you brought that up. As far as detailed records, I always tell people, keep a copy of the rent roll at acquisition and the T12 at acquisition. Keep a copy of your closing statement. Keep very detailed records of your capital improvements so we can demonstrate, okay, you put, $25,000 here, $50,000 here, $75,000 here, and then we can look at the rent roll at acquisition and compare that to the rent roll when you're trying to refinance today and say, okay, you invested X amount of dollars over time, we can build that cost basis and we can show that value creation. It makes the picture a lot easier.
Well, thank you. This was great. Really appreciate all the time and insight. Last questions, I guess we should probably wrap up.
Yeah, I think, yeah.
Anybody else? Okay. So next month we have David Kelly, so I'll let Ravi speak to that.
Great, well, thanks. So next month we're going to cover the legal aspects of multifamily transactions, clearly a big topic. We have invited, as Ryan said, David Kelly. He does documentation for all of our deals within concept of Greg, part of the group. We are a fantastic guy, has a lot of useful information. So if you're thinking about how to do asset protection, what are your liabilities and deals like this, great session to come to. We'd love to see you all there, and look forward to it. And gentlemen, you're okay with people reaching out to you with
Absolutely.
questions, anything? Yeah,
And we'll be here after, so.
yeah, thanks very much.
Great. Thank you, everybody.
Thank you all. Thank you.